Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey. Hey, good afternoon, everybody. This is Tuesday Tech Talk. I'm David Blake, and today we're going to look at the last couple of days, see what's going on in the market, maybe go over a few of the sectors and identify some areas of resistance and support like we always do. If you're new to the meetings, what we do is generally go about 20-25 minutes discussing something something new in the market. Then we open it up to questions, and that can be anything from sectors, individual stocks, to the broader market, whatever's on your mind, and we'll try to go over it. Okay, I had a couple questions came in recently about the CTI, or what we refer to as the cyclical trend index. This is one of the things that Market Edge was known for several years. It started going live in 1992, was tested back to 1975, outperformed the Dow Jones by almost 2 to 1. What it does is it sets our market posture, and what we try to do, rather than being a trend-following model like the Second Opinion, it's a forecasting tool. And what it's designed to do is kind of predict periods of strength and weakness for the stock market. It's found in the market letter on Fridays. We also include the momentum index and sentiment index to measure positive and negative divergence in the market also, and periods of too much optimism or pessimism in the market. Okay, now the CTI is updated weekly, and generally it's going to reverse posture maybe 2 or 3 times a year. And hopefully what it's going to do is it's designed to try to keep you on the right side of the market so that you're long stocks when the CTI is bullish, and you're out or hedging your positions in times of uncertainty or weakness. Now what I'm going to look here is here's the Dow Jones going back probably to going back to about 1987. As you can see with the stochastic oscillator, which I like to look at about a 30 or 36-day time period, you'll see that there's certain cycles that go on in the market where it comes down in relatively the same type of periods. You'll notice that these are what we call these cycles in the market, and they kind of resemble sine waves. And these cycles have demonstrated that stocks in the market tend to experience reversals at anticipated intervals, and these intervals are referred to as the cycles, and they help you kind of pinpoint the highs and lows in the market. And if you can avoid periods like this or periods like this, your overall gains are going to be improved significantly. Okay, here's the S&P 500, the same thing. You can see if you're out of the market in here, over in here, maybe in here, again, or if you're over in here, you're out of the market. Again, your gains are going to significantly improve. Okay, now think of these cycles. I want you, when you look at the market, you're going to kind of think of this as an elastic band going up and down as positive and negative forces are put onto the market. Okay, what we use with these forces, we divided those up into 5 different cycles that we involve in the CTI. Okay, we refer to them as cycles A, B, C, D, and E on the market letter, and the cycles will range anywhere from 6 weeks as the shortest to the longest, which is 4 to 4.5 years. And that, in case you're not familiar with that, actually coincides with a typical business cycle. Okay, I want to intervene here and explain why we took the CTI out of the market letter and out of I took the market posture out at about 2010. Okay, when the Federal Reserve and central banks around the globe began to cut interest rates, they started bringing into place quantitative easing programs, and basically they did anything to prop up the business cycle after the financial crisis to keep things from slowing down. So basically what they did over that time period is, rather than have periods of strength and weakness every 4 years, they just completely eliminated that, and they propped up the business cycle. Anytime they saw a slowdown, they would intervene and bring in more quantitative easing, cut rates until they got down to 0, that type of thing. And it really disrupted the model, so it wasn't working. Because as soon as anything would start to weaken, they would bring in some more quantitative easing, and the market would just reverse on a dime and take off. Okay. Now, in a more in a normal business cycle, and you've all seen this slide several times. Actually, let me go back here. Oops. Okay, here we go. You've seen this slide several times, and what you see is periods of growth countered with natural slowdowns. Okay, over here the economy will hit a bottom where the business cycle slows down. The Fed comes in, they cut rates to stimulate growth. We have what you call an early recovery. When certain sectors will outperform, this translates into a full recovery sector recovery where things are booming, and then the Fed begins to hike rates over here to slow down the growth. They'll rein in inflation that way to keep things from getting out of hand. And what happens is that things slow down in the business cycle, and as a cycle just keeps on reversing every year. Now, as you can see, the stock market over here in red generally will anticipate these turns in the business cycle, and it'll show, like I say, the different sectors that will come into the business cycle and should outperform. We touch on this occasionally. It's been a little bit tough with the, again, when you don't have a regular business cycle, these haven't worked as well as they have in the past, but still is good to know. Okay, what you're going to have on this thing, because since it's not always cut and dried where it's 50-50, what happens is you'll come in here and you have what we refer to as right and left translations. Okay, this is a slide of the business cycle, what you saw before where it went like this. This is a left translation where the cycle begins rapidly. Things pick up. You're coming up here, all of a sudden the Fed has to come in here and go, whoa, let's stop it. Inflation's going to the moon. We need to start hiking rates, and it'll take a longer period for this to adjust for the general business cycle to slow down. What you have over here next is a right translation where the things take off kind of slow, which perhaps we were in here at this point of this last business cycle, and then once they begin to hike rates, it'll rapidly fall down, and the business cycle slows down quickly, or you'll almost come into a recession. So now what happens is the cycles are signed during this period to a numerical value, and we base it on the amount of time that's lapsed since the previous cycle low and high. Okay, the values are positive in the early stages of the cycle over here, and then negative towards the end of the cycle, and towards the end of that period. The shorter cycles receive higher values since they are the dominant cycles, and CTI readings of +1 and higher will indicate a bullish trend in the market, whereas 0 to 15 will signal a downtrend. Okay, this next slide was if we had followed the CTI in 2015. Just because it wasn't working, we did keep adjusting the cycle over like 2011, 12, 13, and 14. It started to come back into sync a little bit in 2014, and we're talking to Tom Ventresca. He originated this thing. We think what happened was once they got down to zero interest rates, and you had a period of a year or two or three that they couldn't just prop things up, you eventually had a business cycle came back into sync with 0% interest rates. Okay, so if you had in 2015, the Dow was down about 2.2%. If we've just had a buy and hold on a index fund, you lost about 398 points. But timing the market using the CTI, you actually would have made 3,181 points, or about 17.8%. That doesn't do that well often, but the reason we stopped using it for a while is because the market never corrected or slowed down for about 4 years. And last year we started to see some actual slowdowns in the economic data that would come in. Okay, this is a proprietary indicator, of course, if you know that, and we do have some very strict rules that I want to go over briefly. What we try to do is when we determine the starting point for each cycle, the rule is that when the count for a cycle nears the end of its predetermined time period, okay, the Dow Jones must post a higher intra-week low when compared to the previous week low. Okay, we were set to reverse to a buy. Okay, over here you'll see we went to November 20th. We went to a sell when the Dow Jones was 17,798. Okay, so through that call, we at the end of the year picked up 1,600 points. Okay, December 31st, we're still at a sell, and the Dow Jones was 74.25. Okay, we're still at a sell as of last week. It picked up 1,436 points to the downside, and last week's low was 15,842.11. So what we're going to look for this week is the Dow Jones needs to hold above that intra-week low for us to reset to a buy. That period looks like we're going to stay for a buy for about 5 or 6 weeks. As we've talked weekly around here, we're certainly due for an oversold bounce. These things can be sharp. What was it, last Thursday? We had a 400-point rally or 500-point rally. It didn't even last a day, however. And, of course, Friday we lost 400 points. We opened this morning with a 200-plus point rally. Things look mixed right now. The Dow Jones is up 64. Russell's actually negative. We're down a half percentage point, down 5 points. The transports, which again keep pointing to lower lows, is only up about 15 points. The Nasdaq's almost a break even. It's at 5 points. So what we're going to watch is that if we break below 15,842 this week, the sell cycle will be extended. Now here's the what we're looking at in the 16. If say this does hold, then we'll go to a buy into March, and we stay on a sell into May, stay on a buy during the summer, then we go to a sell again in the fall, kind of like we did this year, and then October 16th October 21st we go into a sell for the end of the year. Now normally you don't have this many swings in it in the CTI. Part of that is because for most of the year this year we're going to be bearish. Whether that results in a bear market, we'll find out. Of course, like we've been talking in these calls, if the Dow breaks below the about 15.8 or so, it's going to probably induce more selling into the market. Okay, let me go back here to I wanted to show. Okay, these are the actual cycles that we use, the 5 and the cycles A, B, C, D, and E. And currently we are bearish on A, B, and E, and cycle C and D are bullish, which is going to give us the flip. The cycle A is about 6 weeks. That could be plus or minus a week. Cycle B is 18 weeks plus or minus 2 weeks. Cycle C is 36 weeks. D 72. E is 216 weeks, which comes out to about 4 years, maybe 4.5 years. And these things are all harmonic. They will change at the same time as the 6. 3 times cycle A works out to cycle B. 2 times cycle B works out to cycle C. 2 times that, and it goes on like that. I want you just to see, we're going to start publishing these in the actual market letter probably in the next week or 2. So it'll let you see periods of strength and weakness, what we predict or we forecast going forward. Okay. Now, briefly, I just want to touch base on where the Dow Jones ended up last week. As you can see on the candlestick, we made a new low over here. We bounced up, but we had still ended up the period down for the week. We're down to like 600 points. We're still watching these September lows. We're 1659 today. We're up about 70 points. Not sure that's going to hold. You had of course, the S&P 500 actually went down here, closed at 1880. Again, sorry, but the smart chart didn't update on Friday, but we actually closed down here at 1880, and we're looking to see if that's going to hold. If it breaks below 1860, I think we'll see selling pick up again. We always show these real briefly again. These are kind of leading indicators. This is found on the Market Edge Market at a Glance on the home page, and this is the NYSE AD line. You see we're breaking, as of Friday, we're breaking down the new lows again. I think we have more new lows and highs again today. Here is the NASDAQ. It looks even worse. Now over here, when the NASDAQ was trying to push the new highs for October, you saw that the AD line was going sideways. That was showing its negative divergence, and the rally was thinly based. And then, of course, right here towards the first of the year, we've rolled over as people started to sell those FANG stocks and some of the few stocks that actually held the market up going forward. Okay, you may have some questions about the CTI. I'm going to open it up in here, because what we, it's a lot to cover in 20 minutes on here. So if you have some questions, I want you to go to that. We'll keep that up. I'm going to turn this off and go over to the smart chart so we can, we're going to talk about some individual stocks. Pop this up. Okay, and this should bring us up to the, okay, that'll bring us up to our chart. Okay, does anybody have any questions to roll out this week? The questions that we got during the week mainly were about the CTI. We talked about that. Okay, we see somebody typing in here real quick. Okay, missed some of the CTI. Please put up in YouTube. Okay, well, this whole presentation will be up on YouTube probably in about an hour and a half. Again, it's a little bit tough to go over all this and explain it in about 15, 20 minutes. But again, on the market letter, what we're going to try to do is try to forecast this and go out a couple weeks, so you'll be able to project some weak periods and stronger periods in here. And like I said, I think if we can hold above this about 16,000 or 15.9 this week, we may have could get a rally in the market according to CTI. I mean, we're very oversold by any means, and so we'll look at that. But I don't think you're certainly not going to see this market going to new highs anytime soon. Okay, please address individual sectors and their corresponding ETF. Also, what about bond funds like MUN in this market? Okay, let's go. We can go over to sectors real quickly. We had several sectors last week break out into new 52-week lows, which you don't want to see at the market. You want to see them try to make a higher high. If the materials would have stopped over around this $40 range, I would have liked that. But what you're seeing over here, and you can draw these on the smart chart. When you have the 14-day RSI, you can draw in trend lines on these sectors, which also show you that with each little spurt over in here, you were getting less relative strength, and it was becoming weaker and weaker. Now this will come in here again on the materials. If you get up here around 40, 45, that's going to be resistance. But if you see something come up here and take out that resistance level, that can be an indication, just like on a chart, that if you see the RSI 14 break above a downward trend line, it's positive. I don't see a lot happening here to get me excited about the materials. Here's the energy sector. Again, we made a new 52-week low on that. I still think you're going to see capitulation in oil, where you might slide down to the $26, $27 range area. What causes that? It could be the Iran this week coming on, where they say they're going to bring in 500,000 barrels a day. It seems to me if Iran can get anything for oil, they're going to bring it on because they want the money, and they can bring, I think, up to about 1.5 million barrels a day. So I think you're going to see further weakness in the energy. You're at a 52-week low now, and I can see that breaking lower. Okay, the financial sector, we talked about selling this over here, and when they raised rates, we thought that we didn't see the spread in the long-term and short-term yields, and we saw a flattening of the yield curve instead of a steepening. If you follow these things, we suggested that might be a time to sell your bank stocks at that point. We're at a 52-week low over here, but you can see on this ETF, that was the day when we opened up lower and the ETFs didn't get a bid. So it's kind of hard to say that's the bottom down here. I'm looking at this September low for the financials. And again, you see on the RSI, you're seeing a lot of resistance coming in, oversold by any stretch. Industrials, same thing. We're close to a 52-week low. Again, over here, we've talked about the industrials, and the reason we see the weakness in the industrials is mainly because of the strength in the dollar. If you can see the industrial, find an industrial like, say, we talked about some of the gun companies, and some of the companies where they get at least 75 or 80% of their revenues in the United States. You could go into some of those and And look, although the last couple of weeks we talked about stocks like Raytheon and Lockheed Martin and how they've outperformed. In fact, here's a look at Raytheon. It's rolled over a little bit over in here, but this was quite a run. Raytheon makes the missiles and stuff that are used, that we use over here. Here's Lockheed Martin. It's another stock that if you're looking to buy something, it's held up way better than the other stocks. You know, I'm not a big buyer in here, but I think with the CTI going bullish soon, I think you can look at nibbling away at some of these stocks. Okay, here's the technology sector. You saw this thing rolling over. We're not quite at a 52-week low, but today you're almost flat today, so we'll see if this thing holds up. I think in the longer run, this is one of the sectors that you want to nibble away at. XLP, the consumer discretionary or consumer staples. Again, this had a big gap down the other day, but this is another one I think when the market begins to turn, you want to be in this. This is a defensive sector, and if the business cycle is working its way out, the defensive sectors like XLP and XLV would be XLU, utilities, healthcare. These are places where you want to be. Here's XLV. Again, we're trying to find support down here around 66. It was higher this morning. We're flat again on that. In fact, the only thing that's really up this morning right now is the consumer discretionary XLP and XLY consumer discretionary is a little bit higher also. Here's that sector. That's the Home Depots and that. Really had a pullback in here. It outperformed last year. But the consumer discretionary, if you think the consumer is going to stick around, this might be one where you look at buying. But it's not a defensive sector by any means. And if we continue to slow down, you may be a little bit hesitant on that. Let me see if we have any more questions that came in. What about bond funds like the MU in this market? I don't know that you want to look at bond funds in this market quite yet. Certainly they've had a good week with it. But you have the 10 years is down here again at 2.0. Again, that's a flattening of the yield curve, which means the banks aren't going to make any money. But I don't think that the bonds are going to be the place to be in 2016. With as long as the Fed's kind of threatening to again move in to raise rates at some point. Okay, Johnson & Johnson in the healthcare sector. Again, you've got relative strength. You've got some resistance up here. If you can get a bounce in this thing and the RSI is able to break through 50, you might consider it. It's oversold on the stochastics, but it is in a sector that I think is defensive, pays a good dividend. I think the dividend, as long as the yields don't start to get too high, the dividend stocks like the Procter & Gamble's and the Johnson & Johnson, maybe Merck, AT&T, some of the telephones and that, Bristol Myers, those are probably places that you're not going to get hurt. You can probably look to nibble away on some of those. Now, one of the questions I did get was back on the CTI. Somebody wanted to know how you can use that to make money. Obviously, if the CTI goes negative, you're not going to jump out and automatically sell all your positions. What we've done in the past is when you see this CTI is going to a weak period or to a sell in the market, what we've done in the past is we've recommended looking at some of the inverse funds that will allow you to hedge your portfolio to the downside. Even if you just break even during some of these pullbacks where the market pulls back 6, 7, 8%, if you can stay even during those periods because you've bought some of these inverse funds, whether it's the RIDEX mutual fund or an ETF, again, that's a great way to have a positive year versus what the market's doing. So we can go over that, or if you have any more questions about how to use the CTI to help your portfolio performance, that would be one. SPXU. Okay, look at that real quick. Okay, this is the short S&P 500. again, you're so over. Well, in this case, you're so overbought that something like this is going to move rapidly like this. If we break out and you start to see this thing really rolling, you can get a spike in this thing up in the high 40s, maybe to 50. It's something that tells me that we've still got a ways to go on the bottom. I talked about this in the market letter. That is the VIX. You can see the VIX down here at 26.58. And again, if you go on to the market letter, the Market Edge homepage, look at markets at a glance. Back in August, when we started to roll over, the VIX spiked up to around 45, 46. Until this VIX until we see the VIX pop up to around 35 or higher, that just means even though everyone's talking about a bear market and this kind of stuff, they're not doing anything with they're not trading with their money yet. They're just they're talking. And I want to see that the fear set in a little bit more before I think we can get a bounce that's going to last more than a couple of days on that. But again, we've had such a spike down that if you're trading this thing, you may want to take a little bit of money off the table. We talked a couple of weeks ago about buying indexes and funds. When you see the DMI fall, the signal line fall below the positive and negative signal, and then it begins up, it's a good time to be in these things until they flip over, like over here. Okay, the trend was lower. When this thing rolled over after coming off of a low, that was a good trade. That was the time to exit that trade right over in here. So this thing will get you out when it's when it starts to roll over. That's telling you right now the trend is still higher on going down. This is an inverse ETF. So this is telling you that even though it's going up, that means that the trend is still strong. Okay, I don't see we're running about 30 minutes. I don't see any more questions coming in. Again, you want to watch this last week's low, which was 15,842, I believe. I'm not seeing any positive divergence in any of the indicators, which means we probably still have some. We could go sideways to down. If we do break the September lows, you could see a pickup in selling. The Russell 2000 and Transportation Index have already broken below that. That also is telling you that we haven't hit a bottom yet. I wouldn't be any new positions I would buy just for a quick trade. I still see even in the oil trades, anything you pick up in there is strictly for a quick trade at this point until we see see a little bit wider breadth come in. The internal market breadth is still horrible. Last Friday I believe you had 7 new highs versus 938 new lows. That's the biggest number since August 25th or something like that. So again, we're not seeing any signs that a bottom is in yet. But during when you have a change in trend, you get these sharp spikes for rallies that don't hold. Okay, today we're up 200, we're up 50 now. Nasdaq was up 60, or it's up 1 now. Not a good sign. It means that people are selling the rip, and they're certainly not buying the dip. So until we see something a little bit more positive, I would just keep some ammo dry, and we'll see what we can do. Again, if you have any more questions for next week's webinar, please try to get them in early. We didn't really get too many questions except on CTI this week, and it's a little bit easier for me just to talk about some individual stocks if I have a couple of days to take a look at them. Other than that, we'll see you next Tuesday, and we'll see if we can get a little bit of bounce in here this week. But other than that, we're probably looking at a little bit more work to do on the market in the longer term. Thanks for joining me. We'll talk to you next week.